Hey everyone. Last week, the Federal Reserve's Senior Loan Officer Opinion Survey on bank lending practices was released. And for the sixth consecutive quarter, banks have tightened the lending on commercial real estate. Now, over the last year, I've highlighted how the buyer-seller expectation gap has been a key contributor to slowing commercial real estate transaction activity. But this week, I'm going to focus on the other major factor slowing commercial real estate sales, the tightened lending climate. Now, don't get me wrong. Lending is generally available for almost all types of commercial real estate. Most lenders are technically active, but the terms they're offering on debt capital has tightened considerably. Reflecting this trend, the average loan to value on commercial real estate has fallen from the 60 to 70% range, depending on the property type, location, borrower strength, etc., to the 50 to 60% range. Office properties face the most financing challenges, while apartment lending, backed by Fannie Mae and Freddie Mac, are most liquid. But lower loan-to-value ratios and higher debt service coverage ratios have weighed on commercial real estate sales activity. Depending on how you do the math and whether you're measuring transaction count or dollar volume, year-to-date sales through the third quarter are down by somewhere between 40 to 55% from the same period last year. And they're off by 15 to 25% compared to the average activity level of the first three quarters of 2014 through 2019. But why have banks tightened their lending so much? One would think it would be tied to delinquency rates. I mean, if lots of borrowers are late on their payments, it would make sense for banks to tighten their lending standards. We saw that during the global financial crisis. Before the financial crisis, delinquency rates were in the 1% range. By the end of 2007, they rose to 2.5%. By the end of 2008, they were up to 5.5%, and commercial real estate delinquency rates ultimately peaked at 8.9% in the first quarter of 2010. And if you look at the percentage of banks tightening their lending standards during that cycle, the trend roughly aligns with the rise in delinquency rates. But as of the second quarter of 2023, the commercial real estate delinquency rate was just 0.84%. That's lower than any quarter in the 25 years from 1991 to 2016. So while there's a belief that commercial real estate faces significant delinquency risk, it hasn't shown up yet. And the media's focus on the risk commercial real estate poses to the banking system is probably overstated. But as we saw earlier this year, just the perception that a bank is at risk of elevated commercial real estate delinquencies is enough to create a run on the bank. And that is the real risk for banks. Maybe it's the fear of a potential bank run that caused lenders to dramatically tighten their loan criteria. According to the Senior Loan Officer Survey, more smaller banks tightened their commercial real estate lending than large banks. And the top reasons small banks cited for tightening standards were deposit outflows, funding costs, deterioration in or desire to improve their liquidity positions, and concerns about declines in the market value of fixed income assets. So, actually, commercial real estate delinquencies haven't been the problem. As the report cited, the real challenge is a fear of deposit outflows and a desire to increase bank liquidity to mitigate the risk of a run on the bank. I suppose in the mind of bank executives, it's better to reduce commercial real estate lending than risk being labeled the next First Republic Bank. But that's actually good news. It's far better for lending to have tightened because of an abundance of caution rather than because of real problems that emerged. If delinquencies remain contained, as they have thus far, then the fear and caution levels should begin to abate. And when that happens, lending criteria could begin to ease. The timing will largely depend on four macro factors. First, we can't have any more bank runs. A bank run would be a major setback. Second, the signs of an economic soft landing have to continue. A recession would cause banks to keep lending tight. Third, the Federal Reserve can't raise the overnight rate again. And fourth, there can't be any major financial market disruptions. Those are the four major factors investors should monitor to assess the prospects of an easing lending climate. An important trend to track as investors keep their eyes on the horizon.